Hey everyone, welcome back to our economics direct instruction. Hopefully you had a good week last week and you were able to go over the budgeting scenarios because learning how to budget kind of goes hand in hand with our topic today, because being able to live within your means and only spend what you can afford can keep you from using one aspect of the topic today, which is credit. So I'm going to jump right in because we got a lot to do. And I'm going to define what credit is at first. A lot of you have probably heard of it. You've heard of credit cards, you've heard of credit scores. But what is credit exactly? Credit is the ability to borrow financially, whether it's money or assets, on the promise that you will pay it back, usually with interest. And interest is the cost of borrowing money. Now, as we roll through talking about credit and how it works, I want you to understand something. The best scenario is always to purchase something with money you already have. Let me repeat that. The best scenario is always to purchase something with money you already have. Money you've saved up or money you've budgeted for. Now, that being said, in our society, there are things that are very expensive and you're going to need to take out a line of credit or a loan in order to achieve what you desire or need. And we're going to talk about those just a little ways down the road. But please remember that disclaimer. There is nothing more freeing than being debt-free, meaning you don't owe anybody anything. Your money is yours. Your property is yours. It's the other way to accrue wealth outside of budgeting. Okay? So, credit does play a part of our lives. In fact, there's no escaping it. When you turn 18, you will be administered a credit score. So we're going to start there. And a credit score determines your ability to borrow money. Now, your credit score is issued by one of three main agencies. Okay, so I'm going to put this up here. Move it. Going to move around. Okay, so there are three national credit reporting agencies: Experian, Equifax, and TransUnion. Now, they all do basically the same thing, but they also give you a score based on a scale of 850, with 850 being the highest, most perfect credit score you can have, all the way down to not having any credit, which makes it really hard to take out a loan for a car or a home or things like that. You're entitled to one free report each year from each of the agencies. It's kind of the deal the government worked out with them for them to be able to monitor and give you a credit score. But they basically determine how much you can borrow and if you can borrow money from banks and other loan agencies, take out credit cards, have credit limits, by issuing these scores. And each agency works with different companies, so you may have different scores for each agency. It all depends on who you've worked with, who you've borrowed money from, and how you've paid it back. Okay, so show that there. My screen's not big enough, so I'm covering it. But all right, so let's continue on. All right, so what influences a credit score, right? Now, there are several things that influence a credit score. One, payment history. It's good if you pay things back in a timely manner. Pay all bills on time, okay? If you have a credit card and you make a purchase on a credit card, if you pay that off within the term of the credit card, usually within the month, you don't have to pay any interest. You just pay what you would have paid for that purchase anyway. And you get some of the perks that come with credit cards, like airline miles or cashback. But if you miss that due date, usually by even an hour, all of a sudden you've got to start paying interest back. Okay, anytime that happens, your credit score goes down. Now, if you pay back that interest, it can actually help your credit score go up a little bit. But sometimes, even with credit cards, that interest can be as high as 25%. It's a lot of money you're going to have to pay back. Percent of credit limit used. Okay, so this is how much credit you have available to you and how much you've used. The general rule is keep 3 lines of credit, usually a home loan, a car loan, and 1 credit card. And keep that credit card paid off so you have at least 70% of that amount available. So if you have a credit card with a $1,000 limit, you only have $300 of that used at any given time. That shows that you use credit and you use it responsibly, and that can raise your credit score. The total amount of debt you have, okay? This is everything you owe: your house, your car, any student loans you eventually take out, your credit cards, your personal loans. Anything you've ever taken out and borrowed is all added together. The more you have, the lower your credit score is, because you need to be able to pay lenders back. How old your credit is. If you've had the same credit card for 10 years, that's good. If you have a bunch of credit cards that have been opened and closed within a short time frame, maybe a month to a year, that's a bad sign. That lowers your credit score. Recent credit, okay? If you've ever been to a store and they say save 15% if you open an American Eagle credit card today or a Kohl's credit card, it's not good to do that very often, because every time you open one of those, your credit score goes down for a little bit. So if you go shopping on a shopping spree and you open 5 credit cards, that's going to be really bad. And if you go to buy a home or sell a car, or you're in a pinch and you need money, you're not going to be able to get it. Okay, I'm going to be in a live session to go over these and answer questions a lot more. I know I just hit on those quickly, so please join with any questions you have. But all of these factor into your credit score. And your credit score not only determines if you get a loan when you go to buy a house or a car, or if you want to open a credit card, but also how much lenders are willing to give you, and also the interest rate at which you get a loan. A low interest rate is a good thing because you have to pay back less money over time. So what are the actual scores? Okay, this is the scale that most creditors use. If you have a score of 750 out of 850 and above, you have excellent credit. You're probably going to be approved for any loan that you want at a very good interest rate. 650 to 750 is good. You're probably still going to get approved for any loan, but at a slightly higher interest rate. 600 to 650 is fair credit. At this point, some lenders may not lend you the money you want, or at least lend you the amount you want. So you got to be wary. But again, you're not in bad shape if you're 600 to 650. You may just end up paying more in interest over time with that score. 500 to 600 is poor. This is where doors start to be closed. It's going to be hard to buy a house or a car without a cosigner, someone who signs on to your same loan saying they'll pay if you don't. Don't ever be a cosigner. I'm telling you that right now. But 500 to 600 is very, very poor, and it really cuts off your ability to borrow money. Below 500 usually occurs if someone's declared bankruptcy or just has a horrible repayment history. Below 500, you're going to have some work to do before you can borrow any more money. Okay? Hope that makes sense. So if you have a low credit score, how do you improve it? Well, there's several ways. Pay your bills on time. Every month, the credit agencies get reports from every lender that has given you money, and they say, hey, this person's paid their bills on time. Your credit score will go up. Don't apply for new credit cards often. Keep those lines of credit open, but keep low balances on them. The lower your balance compared to the more money you're able to borrow improves your credit score. And the longer amount of time you have that, your credit score goes up. Okay? And check your credit scores at least once a year. And if there's free credit check agencies, use them as well to monitor. Sometimes checking your credit actually lowers your credit score. I know it doesn't make much sense, but that's just how it works. But there are ways around that. So let's go through a few scenarios here and see exactly what would happen to your credit, see if you understand. So I'm going to read this scenario. You can look at the questions on the screen, but I'm going to give you about 30 seconds to come up with an answer and see if you came up with the correct answer. Okay? So scenario 1, you want to purchase a new vehicle and you have your heart set on a brand new SUV. You take out a loan to pay for the car, but after 6 months, you begin to fall behind on payments and incur late fees. Okay, take 30 seconds. Do you think your credit goes up or down? Okay, I think 20 seconds is probably more doable. You probably have an answer. If you said your credit would go down in this scenario, you are correct. Let's say you're at a 750 and this happened, you could drop down to like a 725, 720, even below 700 if this happens. Okay, goes down because you're making late payments and it's getting harder for you to pay off your debt because those fees add on to it, and where you couldn't pay it before, you absolutely couldn't pay it now. If you go to buy a car in the future, this will affect your ability to buy that car. But if the score goes down and you start paying your payments on time, okay, your credit score can eventually go back up. If you eventually pay off that car, that's a good thing as well. Scenario 2, you've been eager to buy a new cell phone for months and you're ready to make it happen. You use your credit card to purchase the phone, you set up automatic billing to pay the monthly expense. At the end of each month, you pay the credit card bill in full. Does your credit go up or down? 20 seconds. Okay, in this scenario, your credit score would go up because paying on time always has a positive impact on your credit score. Now, at this point, I would like to inject that when dealing with credit, your credit score goes down a lot faster than it goes up. You miss a car payment, you miss a credit card payment, your credit score could drop 10 to 20 points in a month. You make a payment on time, it may go up 1 point the next month. So it takes a lot longer to build credit. So if you ever do borrow money, make sure you're able to pay it back on time. It's a lot easier, a lot less headaches. Scenario 3. Let me move it here. Your first semester in college, you take out a small loan to help pay for books. Despite being busy, you get a part-time job. Although you don't have to pay your loan back until you graduate, you've saved enough by the end of the semester and you will pay off the loan in full. Credit score up or down? Okay, we're running low on time, so I'm just going to say, just like the last one, your credit score would go up. You wouldn't have to fix anything. Scenario 4, you just got the keys to your first apartment. You also have a new credit card with a $4,000 limit, and you use it to furnish your new place. Before you know it, you've bought a TV, couch, and dining room. When you get the credit card bill, you realize you've spent your full credit limit. Does your score go up or down? It goes down. Maxing out credit cards and using all of your available credit does lower credit score. The only way to raise your score would be to start paying off that credit card, and hopefully you do it on time because the interest on that is going to be pretty high. Finally, you're planning a trip to Disney World with friends. You get a new credit card offer that lets you earn miles. Even though you opened 3 other credit cards this year, you jump on the opportunity because you haven't bought your Florida flight yet. In this scenario, your credit would go down because you opened multiple lines of credit in a short amount of time. Paying off your credit would be the only way to raise it. Once you have credit cards, though, try not to close them all quickly. Don't just go out and close 3 credit cards because that'll lower it as well. All right, a few myths and then one last piece of information before I turn you loose. Make sure you join the Google Meet for questions. Myth, the decision to grant a loan is based solely on credit score. Credit score helps, but your income, your ability to pay things back is probably the most predominant thing. Your credit score takes time to go up. They only report once a month, so even if you pay off your credit card April 1st, it may be May 1st before you see an impact on your credit score. And the fewer credit cards a person owns, the higher their score. You need to have those lines of credit. Try to have 1 credit card, but even if you don't use it, that'll help better than no credit. Whoops. Okay, there are 2 types of credit, 2 types of debt, good debt and bad debt. Good debt is where you purchase something that increases value over time, like a home. If you buy a home for $100,000 and you start to pay it off, not only does your credit score go up, but in 10 years, if you sell your home, it could be worth $150,000. And not only have you made money on your debt, you've increased your credit score. Car loans are pretty neutral because they don't appreciate in value, but you still need a car. Bad debt are personal loans, credit card debt, things that accrue lots of interest that make it very hard for you to become debt-free. Remember, try your best to save up and buy things with the money you have and only take out credit for good debt. Homes, cars, and then student loans if you have to. All right, that was my PSA. I know we went fast and that was a lot. Please jump on the Google Meet and we'll discuss more and I can go over things a little better. But it's good to see you this week. Make sure you put your name in the comment box below and the worksheets are below as well. Thanks, guys.